Hello again, this is Terry Price, and welcome to the next chapter in our series entitled Tax Cuts and Jobs Act of 2017, How This Affects You. I hope you enjoy. Welcome to Chapter 2 of the video series entitled Tax Cuts and Jobs Act of 2017, How This Affects You. This chapter will cover the changes to medical deductions and Affordable Care Act. Medical expenses are deductible when calculating your itemized deductions. However, they are subject to a floor limit. This means that your total medical expenses must reach a certain amount before you get any deduction credit. The floor amount is based on a percentage of your adjusted gross income. You can see how much that is by looking at line 37 of your 2017 Form 1040. The new law reduced the percentage from 10% to 7.5%. This is one of the tax changes that was in effect for last year as well. So when you filed your 2017 taxes, you would have used the reduced 7.5%. Let's look at an example on how the calculation works. Use an adjusted gross income of $70,000 and total medical expenses of $8,500. The excludable floor limit in 2016 was $7,000. The total deductible amount was $1,500. Using the same amounts for 2017 and 2018, the excludable floor limit was reduced to $5,250. Thus, the deductible amount is $3,250. The result is an additional deduction of $1,750. This is the only change to medical deductions from the new tax law. So we're going to take a few minutes to review what medical expenses are allowed and not allowed. Medical expenses that are deductible are doctors, which includes doctors, dentists, surgeons, chiropractors, psychiatrists, psychologists, and non-traditional medical practitioners. You may be wondering what a non-traditional medical practitioner is. Some examples are holistic healers, acupuncturists, and Scientologist practitioners. According to the IRS, the criteria is not the type of non-traditional medical practitioner, but rather that the medical expenses are for diagnosis, cure, mitigation, treatment, or prevention of disease, and the cost of the treatments affecting any part or function of the body. So, going to the doctor for the fun of it, not deductible. Most all costs for inpatient hospital care are deductible unless it is associated with cosmetic surgery. Outpatient hospital care is treated the same as doctor visits. Therefore, it is deductible in the same fashion as the doctor expenses mentioned above. If a patient lives in a residential nursing home for the primary purpose of medical care, then all expenses, including meals and lodging, are deductible. If someone lives in a residential nursing home or assisted living facility and not medically required to be there, then only the medical care costs are deductible, not meals or lodging. Most all drugs that require prescription are deductible. The key is that they require a prescription. Over-the-counter drugs are not deductible even if you have a prescription. Medical insurance premiums, including premiums paid in the exchange, are deductible if paid directly. Being paid directly means that they are not deductible from your payroll as part of your company's group insurance. These deductions are usually pre-tax deductions, therefore you cannot also claim them as a medical deduction. If your payroll deduction for medical insurance happens to not be set up as pre-tax, then they are deductible. Medicare premiums that are deducted from the Social Security is deductible. You can also deduct payments for a policy to cover qualified long-term care services. Other items that can be deducted as medical expenses are false teeth, reading or prescription eyeglasses or contact lenses, hearing aids, crutches, wheelchairs, pregnancy test kits, and service animals, as long as the service animals assist a visually impaired or hearing disabled person or a person with other physical disabilities. Transportation costs essential to the medical care are deductible. This would include trips to your medical provider as well as trips to pick up your prescriptions. If you use public transportation such as taxi, bus, train, or ambulance, then the deductible amount would be the actual fare paid. If you use your personal vehicle, you can either use your actual cost for the medical trip, such as your gas and oil, or you can use the medical mile rate, which is 18 cents per mile for 2018. You can then add the cost of tolls and parking. Expenses that can be claimed as a deduction must be out of pocket and not reimbursed by either your insurance or medical reimbursement plans, such as a flexible spending or health savings account. These expenses must have been paid in the year you claim the deduction. You can pay for expenses using either a loan or credit card, and the IRS considers it as payment even if the loan or credit card is not paid off. Another provision is that the expenses must be for the individuals or dependents associated with the tax return. There are some items specifically excluded. These are funeral or burial expenses, over-the-counter medicines, controlled substances. Now, some states have legalized controlled substances such as marijuana, which can be used in medical treatment. However, since the federal government has not legalized it, it is not tax deductible. Child care and diaper services, toothpaste, toiletries, and other cosmetics. Most cosmetic surgery, which includes hair transplants, hair removal, and teeth whitening. Health club dues and weight loss programs, unless they are part of a doctor-prescribed treatment for a diagnosed condition. Nicotine gum and nicotine patches that does not require a prescription. And veterinary fees. Yes, I know that we do love them as children, but we can't claim them on our taxes. These lists, both deductible and not deductible, are not complete. If you have expenses that we did not discuss, please consult your tax preparer. In 2014, the Affordable Care Act brought into existence the Individual Shared Responsibility Payment. This is sometimes referred to as the insurance penalty or fine, or you may have heard it called the individual mandate. What this means is that if you can afford health insurance but choose not to buy it, you may have this fine or penalty added to your taxes unless you qualify for one of the exemptions. So, I have some good news and some bad news. The good news, the shared responsibility payment has been repealed. The bad news is it is repealed for 2019, not 2018. So, if you did not have medical insurance coverage for the entire 12 months of 2018, you may be subject to this penalty payment. There are several exemptions, including income levels, that may prevent you from paying this penalty. Please review these exemptions as you are preparing your 2018 tax return. Thank you for watching this chapter of our series covering the changes to medical deductions and Affordable Care Act. We greatly appreciate your time. Join us next time as we will be covering state and local tax deductions. Thank you. For more of this video series covering the Tax Cuts and Jobs Act of 2017, be sure to follow us on Facebook. You can find us using @TerryLPrice CPA. For previous chapters of the series, go to www.terrylprice.com/CPA and click on videos. There you will find all the previous videos. If you have questions, please email us at cpa@terrylprice.com. Please do not post tax questions as a Facebook comment. This video series is to provide some basic information concerning the recent changes in the tax laws. This is not to be considered tax advice. Please consult your tax preparer to analyze your individual tax situation. Thanks for watching.